For the first time in its history, Uber finally became profitable in 2023, much to the joy of its diehard fans. The happiness was short-lived as the company reported another loss in the first quarter of 2024. But why does Uber keep struggling to make a profit despite its massive size? In this video, I'll explain Uber's journey to becoming the most valuable startup in the world and why the decisions it made along the way contributed to its struggle to achieve profitability. It all started in 2009 when Travis Kalanick and Garrett Camp came up with a revolutionary idea to connect passengers with cab drivers directly through a mobile app. Until then, taxi operators were limited to those with taxi medallions. In 2010, Uber launched its first service in New York City with just 3 cars, and it quickly expanded to Seattle, Boston, Chicago, and Washington, D.C. In 2011, they launched their first international service in Paris. In the early days, it wasn't the cutthroat taxi operator that we see today. Uber used to operate black Lincolns, which used to charge a premium to its customers for the service. However, it all changed in 2012 when Lyft was founded. Lyft took a very different approach to the idea of letting almost anyone become a taxi driver. Faced with stiff competition, Uber followed suit, igniting an instant race to the bottom. The rest, as they say, is history. Both companies continuously slashed prices and offered generous incentives to riders and drivers to gain market share. Uber's aggressive pricing strategy, backed by vast amounts of readily available venture capital, led to rapid growth, and Uber gobbled up so much VC money that it raised a staggering $25.2 billion, with notable investments from SoftBank, Toyota Motors, and others. These funds enabled Uber to subsidize rides extensively, ensuring rapid expansion and user acquisition. Some analysts have suggested that at one point, investors were paying nearly 40% of every ride. In its 2019 IPO prospectus, Uber explained this strategy by calling it the liquidity network effect. The idea was to attract a massive number of drivers and customers to the Uber network by subsidizing rides. This would create a virtuous cycle of better wait times, happier customers, more trips, more money for the drivers, and hence, even more drivers and customers coming onto the platform. This would eventually grow scale and maximize margin for the company. The strategy worked, and by 2013, Uber had already expanded to multiple cities and countries, which included China and India. By 2014, Uber was confident enough to expand its offerings into a new and rising industry, being food delivery. Uber Eats was launched to bring Uber's successful model in the ride-hailing industry to the food delivery market, and by mid-2015, it was already the most valuable startup in the world, valued at more than $50 billion. But even though everything looked great on the outside, dark clouds were looming over the horizon. Uber's business model from the start was to grow now and talk about profit later, a strategy that many others in the tech space, like Amazon, have followed very successfully. Throughout its early expansion, Uber kept subsidizing rides, which of course gave it massive scale, but also kept the bottom line red. In a now famous interview with Bloomberg in 2017, Uber gave the first hint that all was not well with the company, reporting a global loss of $3.8 billion, and even though the firm had tried to underplay the losses by highlighting its sales growth, investors did take notice. By 2018, the ride-hailing startup had already completed 5.2 billion trips globally. But despite the stupendous growth, its valuation had dropped from $68 billion to $48 billion, wiping out 30% of its value. The continuous subsidies and price wars Uber had been fighting began to show their scars, and in 2019, when Uber finally went public, its prospectus revealed the full extent of its financial rot to the world. The IPO document showed that while Uber's revenue had scaled to nearly $11.3 billion in 2018, the company's expenses had skyrocketed to $14.3 billion. This translated to significant annual loss with an adjusted EBITDA of negative $1.8 billion. Clearly, Uber was bleeding money, and investors began to ask questions. In response, Uber started cleaning up its act, implementing significant cost-cutting measures while reducing driver incentives in an effort to achieve profitability. In 2015, Uber introduced a new kind of pricing known as upfront fares, which provided both riders and drivers with an estimated fare before booking the ride. It was touted as a mechanism to end the massive public outrage against surge pricing. However, upfront fares were actually a backdoor channel for Uber to significantly increase its take rate or the percentage of each fare it retains as revenue. With a high focus on profitability, Uber made upfront fares the norm across all its markets, and by 2023, its take rate for its core mobility platform was 29.4%, significantly higher than that of its competitors like Lyft, which had a take rate of approximately 20%. Uber also implemented significant cost-cutting measures, like reducing spending on driver promotions and increasing the efficiency of its services. However, despite all of these efforts, Uber's path to profitability remained rocky. In 2023, they reported their first profitable year with over $37.2 billion in revenue and $1.8 billion in net profit. But the first quarter of 2024 saw the company report another massive loss. This time, one of the key culprits was an altogether different kind of problem: litigation. From disputes over driver classification to regulatory battles in numerous countries, Uber has faced continuous legal scrutiny from day one. To understand why Uber is always fighting court battles, we have to go back to what the taxi business was like before Uber existed. In 2011, the taxi industry was tightly regulated. In many cities, operating a taxi required a medallion or a license, which was expensive and limited in number. These medallions were often traded like high-value assets, sometimes costing over $1 million in a city like New York. They created a barrier to entry that kept the supply of taxis low and the fares high, and taxi drivers also had to comply with various safety, insurance, and fare structure regulations, ensuring a standardized service level. Uber's entry destroyed this traditional model by allowing virtually anyone who had a car to offer a ride. This significantly increased the supply of vehicles available for hire, often at lower prices than traditional taxis. However, it also sidestepped many of the regulations that traditional taxi services had to follow. For one thing, Uber classified its drivers as independent contractors rather than employees, avoiding the costs associated with benefits and employment protections. This approach led to immediate regulatory backlash, and authorities and taxi unions would argue that Uber was unfairly skirting the regulations designed to ensure safety and fair competition. Drivers didn't receive benefits like health insurance, paid leave, or retirement plans, which they were actually entitled to. In 2014, taxi drivers across London, Berlin, Paris, and Madrid all came out in large numbers to protest against Uber, and the case was heard by Europe's top court in 2016. And subsequently, Uber lost its license to operate in London in September of 2017. Even though the ban was overturned in 2018, Uber would only be allowed to operate under limited period licenses, and strict conditions were placed on its operation. This license has since been rolled over multiple times. Uber was also accused of using aggressive tactics to enter new markets without obtaining proper licenses, and this has also led to numerous legal battles with city councils and transportation authorities worldwide. For example, in 2017, Uber had to pull out of Denmark due to new taxi laws that required mandatory fare meters and seat sensors. Uber also faced lawsuits over privacy breaches and the use of software to evade regulatory oversight. Its Greyball program, which used data to identify and evade law enforcement officials in markets where Uber was not yet legal, led to significant legal and reputational damage. Meanwhile, Uber was also going through a lot of international litigation. The company was sued for workplace discrimination and harassment, which led to high-profile resignations and legal settlements, especially the removal of its founder and CEO Travis Kalanick, who was replaced by Dara Khosrowshahi in 2017. Even now, Uber had to pay $527 million in legal, tax, and regulatory settlements in the first quarter of 2024, which is partly why the company had to report a loss in the quarter. But that's not the only reason why Uber keeps struggling to make money. Its experiments in international markets have also cost the company a pretty penny over the years. Remember Uber's aggressive expansion to international markets in 2013 and 14? Well, that experiment didn't pan out so well. In China, its major competitor dominated the market with nearly an 80% market share. Uber had to spend heavily to compete with them and reportedly lost nearly $1 billion annually in subsidized rides to attract both riders and drivers. This left a huge hole in its pocket, and in 2016, Uber exited China by selling its operations off to its competitor in exchange for a 17.7% stake. Meanwhile, in Southeast Asia, Uber again faced stiff competition from grab-and-go Jack, leading to further losses. Eventually, it exited that market, selling its operations to Grab in 2018 in exchange for a 27.5% stake in the company, just like it did in China. In India, it continues to compete fiercely with Ola, which commands a significant share of the market through localized strategies and aggressive pricing. In each of these markets, Uber had to fight a relentless battle for dominance, which led to massive cash burns, further straining Uber's finances. But competition from the ride-hailing industry wasn't the only thing that kept Uber struggling. In 2014, Uber launched Uber Eats in a strategic move to diversify its revenue streams while capitalizing on the burgeoning demand for food delivery services. While the venture quickly grew into a significant player in the market, it also brought substantial challenges that adversely affected Uber's overall profitability. Uber Eats had faced inherent high operational costs due to the complexity of food delivery logistics, and each order required coordination between restaurants, delivery drivers, and the customer, adding multiple layers of expense. Unlike ride-hailing, which involves a single driver-passenger interaction, food delivery involves handling perishable items while ensuring timely deliveries, thus increasing logistical challenges and operational costs. Additionally, Uber Eats heavily relied on driver incentives and promotional discounts to attract customers and delivery partners. While necessary to gain market share, these incentives significantly cut into profit margins. The food delivery market is highly competitive, with Uber Eats facing significant rivals like DoorDash, Grubhub, and Postmates, and cutthroat competition forced Uber Eats to invest heavily in marketing and customer acquisition, further straining its profitability. In an effort to strengthen its position, Uber acquired Postmates in 2020 for $2.65 billion, but despite every effort, DoorDash has managed to dominate the industry with a massive 67% market share. So to summarize, Uber's penchant for massively subsidizing rides to gain market dominance, its consistent troubles with taxi unions and city governments, and its ill-advised experiments into new areas such as Uber Eats, and fiercely competitive international markets have led it down a path of little to no profitability, despite burgeoning revenue. So will Uber be able to turn things around in the future? Let me know your thoughts in the comments down below, and please like and subscribe to the channel to get more interesting business insights in the future. Thanks for watching, and I'll see you next time.